A lot of people starting a new business want to know the tax benefits of an S Corp versus an LLC. Well, okay, let's go through the federal tax benefits of an S Corporation versus a limited liability company. Hopefully we can eliminate some of the confusion about these two options so you can choose the right business structure for you. Now, I'm not giving you tax or legal advice. I'm just sharing the differences in federal tax benefits of an S Corp versus an LLC. You should check with your tax or legal advisor before making a final decision on how you want to set up your business. There are tax benefits that a limited liability company and an S Corporation have in common. As a matter of fact, when it comes to federal income taxes, there are more similarities than differences. First, with both an LLC and an S Corp, the income and deductions are passed through to a member's or shareholder's individual tax return. In other words, the business itself does not pay federal income taxes. So even if a member or shareholder never takes profits out of the company, they will pay taxes on their share each year. They will pay income tax at their personal income tax rate. S Corp and LLC tax benefit number 2. As long as a member or shareholder cannot be covered under a spouse's health plan, health insurance is deductible. In order to deduct it, a single member LLC has to make a profit, a multi-member LLC has to have net earnings from self-employment, and a more than 2% S Corp shareholder has to have the health insurance premiums included in W-2 wages. A spouse and dependents can be included on the policy. Children who are under the age of 27 at the end of the year, even if they are not dependents, can be included on the policy too. The policy can be in the member's name or in the name of the business. In addition to health insurance premiums, you can deduct dental insurance premiums, vision insurance premiums, and part of the premiums for long-term care. This is a huge benefit because a lot of taxpayers can't itemize their deductions anymore since the standard deduction is so high. Even if you can itemize, you can only deduct medical expenses that are 7.5% over the adjusted gross income on your 1040 tax return anyway. So it's definitely a win being able to deduct up to 100% of health insurance premiums. And if you don't have enough business income to deduct 100% of your premiums, you can always just itemize the amount that you can't deduct. S Corp and LLC tax benefit number 3. A QBI qualified business income deduction is available to both an LLC and to an S Corp. You can get up to an extra 20% deduction on your 1040 individual tax return. This 20% can be taken in addition to the standard or itemized deductions. There are requirements that you must meet in order to take the deduction though, but the requirements are a bit detailed, so I won't get into that here. Please click on the link above if you want to hear more about the QBI deduction. So those were a few tax benefits that an S Corp and an LLC have in common. Now here are some differences in tax benefits of an LLC versus an S Corp when an LLC takes the default federal tax status. 1. LLC members do not have to pay themselves a salary because they are not employees, but each member will have to pay self-employment taxes on their individual tax return to put into both Social Security and Medicare. LLC versus S Corp tax benefit number 2. A single member of an LLC can pay for business expenses out of their own pocket and include these expenses on Schedule C. A single member can also deduct vehicle mileage and the home office deduction on Schedule C. The member would just need to keep a mileage log, receipts, and other documentation as proof of the expenses. If the business is a multi-member LLC, it will be taxed as a partnership by default. When it comes to reimbursing expenses for things such as vehicle mileage, cell phones, business meals, home office expenses, or other business expenses, members can take the easy route and deduct these expenses on Schedule E of their individual 1040 tax return. You would just need to add a statement in the LLC operating agreement saying that specific expenses will not be reimbursed by the LLC and must be paid by the members. Another way to do it is to have the business reimburse members for expenses instead. This is the more complicated way of doing it because members would have to submit expense reports to the company. Also, if the business has a loss, a member might not be able to take their portion of the loss on their individual tax return. Here's what I mean about reimbursing members for expenses when the LLC has a loss. Let's say that you have your home office expenses reimbursed to you and deducted under the LLC. If the LLC has a loss that year and your investment in the LLC is less than your portion of the loss, you won't be able to take your full portion of the loss. You can only take the loss up to your investment in the LLC. Any loss that you can't take can be carried forward forever. This means that your home office deduction will be wrapped up in that loss. The problem is it might take a while before the business can generate enough income to restore your investment so that you can finally take the loss on your personal return. On the other hand, if you were to deduct those home office expenses on your personal return instead of having them reimbursed, you could freely deduct the expenses on your personal return and you wouldn't have to worry about how much you have invested in the LLC. Remember though, these have to be expenses that the LLC is not willing to reimburse. Now, if your LLC doesn't normally generate a loss, most of the time you will save more in taxes by having the LLC reimburse its members. LLC versus S Corp tax benefit number 3. An LLC can choose how it wants to be taxed. The business can elect to file taxes as an S corporation, a C corporation, a partnership, or as a sole proprietorship. If an LLC wants to file taxes as a corporation, the business will make that election on IRS Form 8832. If you don't file an election and you have a single member LLC, the IRS would treat you as a sole proprietor. If you have more than one member and don't make an election, the IRS will automatically classify the business as a partnership. If you're the only member, you will file your federal income taxes on a Schedule C that will be attached to your regular 1040 income tax return. If you have more than one member, the business will file Form 1065 for a partnership. Each member will receive a K-1, which shows the allocation of that member's share of profits, losses, deductions, and credits. The allocations are based on the operating agreement that you decided on when you set up your LLC. You can set up your operating agreement percentages however you'd like. It doesn't matter how much of the company a member owns. For instance, a member can own 5% of the company and receive 75% of the profits, but only 10% of any losses. You can even have the percentages change over time. So you could have a member receiving 75% of the profits in the first 2 years and switch it to 50% of the profits after 2 years. If you decide to have your LLC taxed as an S Corp, you won't have this type of flexibility. The same is true if you decide to set up an S corporation that is not an LLC. The benefit that an LLC filing taxes as an S Corp has over a flat-out S corporation is an LLC does not have to follow all of the corporate protocols. And this leads us to the differences in tax benefits of an S Corp versus an LLC. S Corp versus LLC tax benefit number 1. Primary reason that members of an LLC will choose to file taxes as an S corporation is so they can save on employment taxes. With an S Corp, shareholders are also employees of the business. As employees, shareholders pay themselves a salary that is reported on a W-2. As shareholders, they can also take some of the business profits as distributions. Shareholders don't have to pay self-employment taxes on distributions. They also don't have to pay federal income taxes on distributions if it's less than their investment in the business. Not having to pay self-employment taxes is a big deal because LLC members pay self-employment taxes on all of the profits of the LLC. Now, owners do have to pay themselves a reasonable salary. So members can't just bypass wages and pay out all the profits as distributions. Reasonable usually means a salary that is in the same range as what would be paid to someone else with the same experience doing the same type of work. Here's an example. If you have a single member LLC with a net profit of $100,000, you would pay $15,300 in self-employment tax. Let's say that a reasonable salary for you is $80,000. If you elect to pay your taxes as an S Corp and pay yourself that $80,000 salary, self-employment tax for you and the LLC combined would be $12,240. You would not have to pay self-employment tax on the remaining $20,000. You might have to pay federal income tax on it though. So as you can see, you would save thousands more in taxes by filing taxes as an S Corp. S Corp versus LLC tax difference number 2. Profits, losses, deductions, and credits are allocated based on the shareholder's share of stock in the business. So you can't just allocate profits and losses however you want. Remember, you can allocate it however you want with a regular LLC. S Corp versus LLC tax difference number 3. If a shareholder pays business expenses out of their pocket, they have to submit a request for the business to reimburse them. Shareholders cannot deduct business expenses on their individual returns. If the business sets up an accountable plan, those reimbursed expenses will not be taxed. If the business does not set up an accountable plan, reimbursed expenses would have to be included in the W-2 wages of shareholders. This would make the reimbursements taxable. If you do decide to go with an S corporation for your business and you want to know how to write off home office deductions or other business expenses by using an accountable plan, please watch the video on the lower left of your screen. If you don't know about the new law that requires some LLCs to file additional paperwork regarding its owners, please watch the video in the upper left of your screen. See you next time.